Welcome to the second episode of Impact with Digital, where we explore the triple bottom line impact of digital transformation. Digital transformation has a positive impact on your organization's performance, but it also allows you to make an impact on society as well as the environment. And in this episode, we'll use a case study to highlight how this triple bottom line impact can be achieved. Of course, organizational performance is important, but I think in today's day and age, your consumers demand that you also, as an organization, whether you're large or small, make an impact on your community, as well as make your contribution to the environmental impact. So let's get started. For the purposes of this example, we'll use a fictitious bank, and I'll call it SME Bank. To be honest, I tried to find a name of a bank which wasn't taken, and that was quite a difficult job. So I think the easiest option would be to just call it the SME Bank. Now, I also use the fictitious example to ensure that it gives me the flexibility to demonstrate this impact, but also ensuring that it doesn't breach any confidentiality. Now, let's assume it's a bank that focuses on medium-sized businesses. It's based in the UK. It has 5,000 medium-sized business customers, and it targets those businesses that are turning over more than £5 million in annual revenue. Currently, their loan portfolio size is 1.5 billion. They make a revenue of 150 million, and the profit margins are roughly 10%, and they have a market share of 1%. So it's a bank that's moving along pretty steady. However, it's starting to see some challenges in the market, and the board is trying to think about what it can do to respond to the coming disruption. So let's look at some of the disruptive forces shaping the thought of the board. So firstly, it's starting to see slow growth, possibly because of the economy, but I think it's more likely because there are new competitors coming into their space. The UK has seen many fintech alternative lenders coming into the market. And to be honest, if you're an SME nowadays, the default lender that you would approach is potentially going to be an alternative lender compared to a traditional bank, because it's a lot easier and a lot more swifter to get a loan from an alternative lender. There's also quite a few neobanks coming into the market. A neobank is effectively a bank that only has a digital channel and no branch infrastructure. So there's various banks that are coming into the space, and they've managed to establish themselves pretty well. So SME Bank is starting to feel the pressure quite significantly. SME Bank is pretty much a high-touch bank. They like to know their customers. They like to see the customers' operations in order to make the decision. They very much rely on people to make creditworthiness decisions, as well as a little bit of data, but obviously data in this space is a little bit harder to get. So the operational costs, because of the high-touch approach, is relatively high. Now, generally, you will find that traditional banks have a cost-to-income ratio of anywhere between 50 and 60%. And that's pretty much the standard. The digital banks basically have managed to bring that down. They'd like to go further down to smaller businesses. But smaller businesses don't really have the data that they need to make credit decisions. They don't have credit bureau data. They themselves, small businesses, lack proper management accounts. So this is a big challenge when you have to do credit worthiness assessment. So looking at the pressures that the board is facing, or the bank is facing, the board decided to embark on a digital transformation strategy. Now, in this case study, we're not going to go through the challenges of digital transformation and how to launch a project that's going to succeed. And also I covered our Swifter framework and those kind of aspects that are very important when you're embarking on digital transformation. In this case, we're going to assume that digital transformation goes according to plan and yields the results that the board intended. So what do? They decide to join the competitors and launch a neobank, or a digital-only bank. They create a separate brand, completely separate from SME Bank, so that if there was any failures, that wouldn't have a detrimental impact on the mother bank. They call this bank the Small Digital Bank. Again, it's a made-up name just to try and find something that's available. They create a nice logo, nice branding. It seems like an independent bank from the mothership, but it is a fully licensed subsidiary of the main bank. So they obviously went through the hard process of getting a license, and the bank decides to target micro and small businesses. So micro businesses are really businesses with employees of less than 10 people in the organization. This bank is going to only operate through digital channels, and therefore it's going to have a lower cost to operate. And potentially, they're going to try and match the customer experience offered by some of the disruptors that are coming into the market. So does this sector make sense? Obviously, we're going down the curve where smaller businesses are traditionally higher risk. So let's look at some statistical data produced by the Department of Business and Trade, the UK government. According to the data, the UK has roughly 5.5 million businesses registered at the Companies House. Of those businesses, 95% are micro businesses. That means these are businesses that have less than 10 employees. They contribute 31% to the overall employment within the company sector. They also represent 20% of the turnover of all companies. At the other end of the spectrum, you've got large organizations with employees exceeding 250. They represent a really small proportion of all the businesses in the UK, 0.2%, which is really quite small. However, they contribute 40% to the employment of all companies in the UK. And in terms of turnover, relatively high turnover because these are bigger businesses, so 48% of all turnover. In the middle, we've got small businesses with employees between 10 and 49, and medium businesses with employees between 50 and 249. So small businesses represent 4% of the total population. Medium businesses, only 1%. Remember, SME Bank was targeting medium businesses. So it's a pretty small market that they were targeting. And the growth prospects are always going to be limited, especially because they've only had 1% of the market share. Even increasing their market share means that they have a very small total addressable market. So going down the path of micro businesses means that they'll have a much wider base of the pyramid. So moving from medium to small, they're increasing the base of the pyramid of the customers they serve. Now that means more customers means more work. And if they didn't go down the digital path, then potentially this would mean an incremental cost in serving these customers. So digital is the only way to go to ensure that you're not correspondingly increasing costs as you increase your customer base. Now, the sector is also quite encouraging because it's backed by government guarantees. So the British Business Bank, which is a government-based bank, provides the Growth Guarantee Scheme, which provides a guarantee for up to 2 million in loan facilities. So in this case, the government would guarantee 70% of the loan so that this bank potentially would only lose 30% if there was a complete default. The loans can be for anywhere between 3 months and 6 years. So I think from a risk perspective, the risk is mitigated by government guarantees and also by the fact that they will be much better at credit risk management, as you will see further in this case study. So this is the right decision. It seems like the right market to go after. So let's look at 4 things they have done which makes an impact on their business. So the first thing, this is the digital-only distribution model. Now, traditional banks operate through expensive branches. They have a lot of paperwork and manual processes. They have high human interaction. This results in high operational costs, right? So small digital bank in this case has taken that away. They've streamlined processes and made it fully digital. So fully digital onboarding, fully digital end-to-end loan application process. They've replaced customer services with an AI-based chatbot, which addresses most of the queries coming in from customers. It can also go and interrogate accounts as and when needed. Only in emergency cases, only when there's really a need to, then they will be transferred to a live agent. Given that they don't have to have branches, and this is only online, their overhead costs reduce quite drastically because they don't need the infrastructure of branches and technology. They also operate very much in the cloud. So again, they don't need servers, etc., reducing costs. And it's purely paperless processing. Previously, they had a 30-page form that companies had to sign up, whereas now it's a slick online process. So the impact of this could be that potentially they could reduce their cost of income ratio from between 50 and 60% for traditional banks to, let's say, 39%, substantial reduce in costs for serving customers. They can provide 24/7 support, which makes it a lot more convenient for customers. And as we said, they go 100% paperless. So the digital-only distribution and AI chatbot helps to reduce costs quite substantially. The next thing they do, remember they had a problem to assess the credit worthiness of smaller organizations that really don't have public data like credit bureau data. And most of the time they have inaccurate company accounts. They don't really invest in company accounts. This will probably be an exercise they do once a year and not really tracking things, especially for micro businesses. This is quite typical. Things go on day to day, and the accounting side is sometimes taken care of just by a bookkeeper. There's potentially delays in capturing receipts, etc. So the company records are not as accurate. So they need some other way of assessing credit. And this is where neobanks and fintech alternative lenders have really excelled. So what do? They rely on non-traditional data. Let's take some examples. So we know in the UK we have open banking. Open banking is a way where the banks open up their accounts to third parties, obviously with permission of the customers. And this has some benefits for smaller banks, alternative lenders. They can basically tap into the current account of the business, and they can see all the income and expenses coming through and have a very good understanding of the kind of management accounts of the bank. They can also rely on online software, accounting software like Xero, QuickBooks, where those systems will provide a real-time management account effectively without the small business having to prepare these. So this data is very valuable because they can see day-to-day operations of what's coming in, what's going out, which helps them make an assessment. They can also rely on e-commerce data. So if this business is an e-commerce type of business selling goods and services online, most of these businesses will operate through some sort of a platform. For example, Shopify and Amazon. They will also have payment processing using systems like Stripe and PayPal. Now, again, through APIs, through basically a connection into these systems with permission of the customers, small digital bank can get a good understanding of what sales these organizations are making, what commissions they're paying to these platforms and potentially affiliates. They can understand the income and expenses a lot better through these platforms. Even before the money lands in the bank, they're kind of understanding what the sales looks like. They can also look at seasonality to see when sales are actually higher and sales are lower potentially. So understanding what sort of flexible funding needs these smaller organizations will have. They can look at utility payments. So again, they can ask for how often and how quickly do you pay a rent? Do you pay a council taxes, etc.? That could form another form of data. And social media, interestingly enough, could also be a good source to understand creditworthiness. So if an organization is getting a lot of complaints or bad reviews, that could bode less well for an organization because they're potentially going to lose sales. They might have to actually pay out for compensation because of errors, etc. So business review, reputation of the organization and social media is an important indicator. They could take all this data and put it into an AI system where machine learning analyzes all the data and comes up with analytics, which could be better than manual underwriting. They could feed this into an automated credit scoring model, requiring no manual intervention for most of the loans. So what could be the implications of this? So with such a sophisticated system driven by AI and alternative data, and with data being in abundance at this level, the data we talked about, loan approvals can be done in one day. So instead of previously, where it would take 3 weeks to assess the application, in this case, the application can be assessed in as little as 1 day. 90% of all these potentially could go through automatically. So automatic approval of the loan without any intervention from a credit officer. In some cases, obviously, the credit officers may need to check certain things. And in such cases, they will obviously have to have some manual intervention. And because of the level of analysis that's going into this credit decision, you're going to potentially have lower default rates coming through because the AI system sometimes is better at analyzing these kind of non-traditional data sources. Obviously, the AI has to be programmed in the right way and need to make sure there are checks and balances to make sure that these models are accurate. So the first thing, they did a digital-only bank. Now they've done some AI-driven credit assessments using alternative data. They add another layer. They add a financial education and digital tools for SMEs. Now, why is this important? Because micro businesses fail due to poor financial literacy most of the time. They're just trying to get income and manage the day-to-day business that they sometimes overlook financial literacy, leading to higher risks for lenders because of higher default rates. So if you could educate this sector, you could provide them with tools that help them to manage the business better. It will have a downward impact of lower default rates. Now, traditionally, in many developing countries I work in, these micro lenders would generally get people into a classroom and provide kind of training, which is very inconvenient for the SME, but also expensive for the micro lender. So having a digital platform where your customer is going to be checking in on the app or on the website regularly, it's a perfect opportunity to provide that training. So let's take an example. They could have an in-app coaching. This basically could provide the SMEs with real-time cash flow, for example, because all the accounts, all the data is there for the AI systems to look at. It can provide potential opportunities for the customer to quickly know that they're going to need a loan in the next 3 months because of certain expenses coming through, etc. So these tools can forewarn them of cash flow crunches when the loans would be needed. And again, this gives a small digital bank the opportunity to provide more flexible financing. They can have personalized educational content through videos, through quizzes, etc., on financial planning, tax, growth strategies, etc. Again, this helps with making businesses more resilient. They could have AI-powered forecasting tool, which we already touched on a little bit, which can help the business plan for repayments, avoid any financial distress. And the small banks could incentivize these organizations who take this learning, for example, with potentially lower interest rates or better terms, encouraging them to take this financial education. The overall impact of this financial education tool would be reduced default rate through better financial management by these smaller organizations. Education improves business and financial resistance or resilience. Because of the added value, they also tend to get more referrals. Customers are likely to refer their colleagues or their peers in the sector to this bank. And most importantly, because of the financial literacy, you get a drop in the failure rate of organizations, which is good for the company, but also good overall because potentially you would have less job losses, etc. The final thing they do is they embark on a new loan scheme called the Green Lending and ESG Focus. So traditional lenders lack green loan models tailored for SMEs. They're missing out on this ESG opportunity, which is quite a big issue in the UK and across the globe, where governments are trying to encourage businesses and individual citizens to be more responsible and ensure that they're doing things to protect the climate. So they launched this new product. As part of the loan application, they could have an AI-driven sustainability score, and the sustainability score could influence the interest rate. And so for a higher score, where the businesses are more responsible, they could get a low interest rate, for example. So they launched a green loan. It's a specialized product for green infrastructure. And the products, for example, could be giving a loan to a local bakery to invest in electric-only vehicles, for example, or for small farmers to have solar panels to meet all their electricity demands. So as a result of this product, the green adoption rate increases, let's say by 30% across the board, across the customer sector. And because of this focus on green lending and because of the digital solutions they come up with, small digital bank becomes a market leader in this space. So these are the 4 strategies they've adopted. Now let's look at what are the overall impacts, and let's look at the triple bottom line impact of these 4 strategies. Now remember, we're assuming that digital transformation was implemented with 100% efficiency and accuracy. So the triple bottom line impact. So first we've got economic impact, which is basically performance impact for the organization. So in this case, remember they had 5,000 customers. They now managed to go from 5,000 to 15,000 in 3 years. Because remember, they're going down the pyramid where there's a bigger base of customers to tackle. Their portfolio grows from 1.5 billion to 2.2 billion. Revenue increases from 150 million to 230 million. The profit margin increases from 10% to now 24%. Remember, with smaller organizations, because of the perceived higher risk, the interest rate can be higher potentially. And also remember that operational costs are going down. The difference between revenue and costs is going to be a bigger gap. So they manage to increase their market share from 1% to potentially 1.9%. And all of this performance, operational performance, as well as financial performance, is done at a lower cost base compared to previously. Had they expanded the traditional model, it would have meant that they would have had to correspondingly increase operational costs. In this case, using digital, they're managing to scale. Scale means increasing the performance of the business, which is mainly revenue and profit, without corresponding increase in operational costs. So they're obviously leveraging through digital technologies. So the economic performance is fantastic, but let's look at the wider impact because of this digital transformation strategy by SME Bank. So on the social side, they're now having more of an impact on financial inclusion. Remember, micro businesses really struggle to get loans from traditional lenders because we said they lack historical data, they lack proper accounting records, they lack credit bureau data sometimes. So the focus on micro businesses basically helps to economic empowerment because these smaller businesses now get loans, they invest that money appropriately in growth of their business. As a result of that, they create local jobs in the community, they create local growth, and their success means that jobs are created, more lives are impacted in the community in a positive way. They also provide enhanced business skills through this digital platform to these smaller businesses, which means that the likelihood of such businesses failing and obviously destroying jobs becomes less of a likelihood. And overall, there's an improvement of livelihood of the owner of the business, the staff, as well as the community around them. So there's economic impact, social impact, and let's look at the environmental impact as well. So higher adoption of green businesses or business technology is mainly driven by cost reduction. If businesses can reduce their electricity costs, for example, then they will definitely go for it. And if this organization is providing green loans, then I think there's definitely a match there. And if these loans are favorable with a bit of education, organizations will be more encouraged to adopt these green technologies. So reducing the overall carbon emission through such green loans. Remember, they're also reducing paper consumption in the bank itself with taking away paper-based forms, etc. And that again contributes to the green environmental aspects. All of these efforts promote sustainable business practices. So we can see in this case study that not only did SME Bank improve their performance for their shareholders, but they also had a big impact on their society around them, as well as making a huge contribution to the environmental considerations. Of course, we must not forget that such a move, such a digital transformation, is not without its own problems. So, it will require a huge investment. It will require a new license from the regulator. So it doesn't come with challenges. Let's be honest about that. But all I'm trying to show here is if successfully implemented, it can have an impact wider than just on the organization. So behind every loan that SME Bank makes is a story about a mother who is able to expand her bakery business from her house to a high street. A young enthusiast and entrepreneur who was able to launch a sustainable clothing line with the help of the SME Bank. The bank made their dream a reality. In the process, they helped the community and the environment. The bakery employed people from the community, and the clothing shop benefited the environment. Both micro businesses were able to secure a loan that they may not have been able to secure if they relied on mainstream banks. Digital transformation is more than technology or a new business process. It's about enabling people to improve their lives, the community, and the planet. So what are the lessons we learned in this case? So digital transformation basically isn't just about technology, which is sometimes a mistake that many organizations make. When they lead with a technology-first approach, which oftentimes it fails. And as we've covered previously, McKinsey's research highlights that 70% of digital transformations fail. It's not surprising when you look at the technology-first approach is generally going to lead to such failures. Digital transformation opens the door to micro and small businesses to access finance they couldn't from mainstream banks. Technology combined with innovation in business models can help overcome limitations of serving the underserved. As we've seen previously, the lack of data limited lenders to lend to smaller organizations. Technology and alternative data source overcomes this challenge. Digital transformation, digital strategies help to reduce costs, deliver better customer experience, and it also helps to open new market channels. As we've seen in this case, SME Bank was able to target the micro businesses, which they couldn't without the digital transformation. And most importantly, digital transformation, as we've seen in this case, and I tried to illustrate, it really drives wider impact. So in closing, I'd like to say that digital transformation is about supercharging organizational performance. Yes, that's a given, right? That your first goal is you want to supercharge your organization, get an organizational benefit. But you can also, in the process, benefit the community. You can also become a responsible business by adopting green technologies within your organization, but also encouraging your customers to adopt such policies through the green loan schemes. So this was a case study to illustrate the triple bottom line impact of digital transformation. I'd like to encourage you to think about how you can apply these principles of wider benefits in your own business or organization. So why not share your thoughts and experience with us on social media? If you're watching this on YouTube, leave a comment and let's continue this conversation. Until next time, this is Jay Tikam, your host, signing out.